A quick overview of U.S. estate tax. U.S. estate tax is a federal tax imposed on the transfer of the estate of a deceased person. Here is a quick overview of the IRS tax implications of estate tax. As of 2023, a federal estate tax exemption is 12.92 million US dollars applies per individual. This means if the total value of an individual's estate is below this threshold, no federal estate tax will be owed. If the value of an estate exceeds the exemption limit, the estate is taxed at a rate that can range from 18% to 40%, depending on the amount over the exemption. An estate tax return, Form 706, must be filed if the gross estate exceeds the exemption limit, generally within 9 months after the date of death, unless an extension is granted. The estate must be valued appropriately, which includes all assets owned by the deceased, such as real estate, bank accounts, investments, and other tangible and intangible assets. Debts and expenses may be deducted from the gross estate to determine the taxable estate. Some states also impose their own estate taxes, which can have different exemption limits and rates. It's important to consider both federal and state tax implications when dealing with estate planning. The IRS allows for portability of the estate tax exemption between spouses. This means that if one spouse dies and does not use their full exemption, the surviving spouse can use the remaining amount, potentially doubling the exemption for their estate. Thanks and have a brilliant day.